How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group, and today's topic I want to discuss with you a guaranteed annuity and is what is a guaranteed income annuity. Now, dependent upon a person's specific retirement income goals or safe accumulation goals, they typically take their money, whether that be accumulated through some sort of 401k account, 403b account, IRA account, or just simply cash accounts or non-qualified accounts. They could take a portion of these monies, of this kind of, think of it like little buckets, and you could place it and purchase an annuity contract. Now, some carriers, typically with annuities, with any sort of annuity, it has to be offered through an insurance company. So, dependent upon your age, dependent upon your specific income goal, on how quick you want to turn on your lifetime income stream or your income stream, would determine how much that lifetime income stream will be, or what type of control factors you have regarding that specific retirement account. What do I mean by that? Well, if we take an individual that says, okay, listen, I have $500,000 that's currently sitting in an IRA account. I'm 60 years old, and out of this $500,000, I have a specific income need. I do not know how to accomplish this income goal by leaving it within this IRA account. There's a risk associated there that if I keep pulling out this money and I'm paying fees and I just keep living and living and living, I could outlive that money. So they might say, okay, listen, I want to take this money and I want to take a portion of it to produce exactly $10,000 a year of lifetime income every single year, and I want to do that immediately. So this person, out of the $500,000 amount, you could go look at all the different annuities and different immediate annuities, depending upon that area, depending upon that person's situation, and go and see exactly which carrier would be the most favorable for a $10,000 annual income amount, or something that would equate on a monthly basis to $10,000 on an annual income amount to correlate properly. So maybe out of that $500,000, that might only take $200,000 to accomplish that goal, or it might take $150,000 to accomplish that goal. Whatever that specific dollar amount is, that person can leverage the smallest amount of dollars possible, place it in with an insurance company through an annuity contract, and turn on that lifetime income stream instantly. Now, where the guaranteed section of it comes in is all depends upon the claims paying ability of the insurance company. Now, depending upon if you're going through an immediate annuity, a fixed annuity, an index annuity, a hybrid annuity, they have certain legal reserve structures set up, making sure that they're very, very safe contracts. But once again, you can never use the word guarantee when you're looking at actual income streams through an insurance company, and that's why you're always going to see on any like illustrations or product brochures, it's based upon the claims paying ability of the insurance company. So when you see this word guaranteed income and you say, okay, if I'm utilizing $200,000, it's going to produce me $10,000 every single year, every single year, every single year, you understand that if you live to your hundreds, you're making out like a bandit. You use $200,000 and you're getting paid $10,000 every single year. If you live for another 40 years, you made $400,000 off of that $200,000 investment. Or you might have the other individual that unfortunately passes away after 10 years. So out of that $200,000, the insurance company got to keep $100,000 of it because it'll be 10 years at $10,000, which would equal 100 grand. The person used $200,000 to place that money in that type of insurance annuity contract, and the insurance company is walking away with a $100,000 net profit. So this was a constant game that was being played throughout insurance companies and individuals that were looking to place money in annuity contracts. And that's where some of the problems lie regarding annuities. So now the other aspect that kind of came out, and these types of annuity contracts that were more and more attractive, were blended types of annuities known as hybrid annuities that allowed somebody to receive account value growth, kind of like more growth on their bucket of money. Kind of think of it with a bucket with a little lid over it, and then when that person's looking to defer growth, either turn it on within 30 days or defer growth, within 20 years, every single year that they wait, they have something known as an income rider and an income account that would essentially accumulate to then provide lifetime income at a later date in time. So that's kind of where you really have to look through and see whether or not a hybrid annuity contract or a type of annuity contract is going to be favorable for your situation, or is it more hooplas and more smoke and mirrors on this type of income guarantee aspect. So to kind of reiterate, we have the two different types of annuities, right? For immediate income needs, for guaranteed income needs. You have the type that forces your money, that is, you're essentially taking a bucket of money, placing that with an insurance company, and the insurance company is providing this individual a set stream of income for either their life, theirs and their spouse's life, or a set duration of time of just pure income amount. Now, the downside to this type of annuity concept that way, this is known as an annuitization. The person is essentially annuitizing their contract. So if you ever heard about an annuity or annuitization or annuitize, that's exactly what they're meaning. This individual is surrendering their money to the insurance company, and the insurance company is giving them some sort of insurance that they're never going to outlive that income stream. But if this individual passes away before that count would have been paid out to them, well, then their beneficiaries don't receive anything. If they just keep living, then the insurance company is losing, and they have to keep paying out that specific contractual guarantee of income. So each carrier is going to have their own different way, to their own different niche platform on how they offer those types of contracts. A lot of insurance companies, they want you to annuitize your money. That's the whole purpose behind an annuities, so that they could control the money. They could understand exactly how much money they're going to be paying out to the individual, and they could leverage the law of large numbers, meaning for every person that purchases an annuity contract, for every person placing their premium dollars in, they're paying out income to new individuals that are now retiring, and the insurance company is able to leverage that large pot of money, that law of large numbers effect. With the hybrid annuities, and this is why I like the hybrid annuity aspect, is because rather than if that individual passes away, like that scenario I showed you before, if they had a $200,000 contract and let's say they want to turn on income instantly, rather than doing it through the form of annuitization, they threw it through the form of their income rider. So if they're getting paid, $10,000 per year, and let's say that their actual physical money doesn't grow and the markets are just crashing every year, and let's say their bucket's staying exactly the same, every time that they're taking out $10,000 and the companies are paying them $10,000 is going to reduce their retirement bucket or that cash bucket proportionately, meaning $200,000. Let's say if the person was getting a $10,000 payout for 10 years and then passed away after year 10, you're going to have, in a perfect scenario, you're going to have $100,000 left in that bucket. This $100,000 is now going to get paid out to the beneficiaries, as opposed to just going the immediate, that annuitization route, where nothing's going to get paid out to the beneficiary and the company's winning every single time because they're understanding the actuarial tables much better than how the client can leverage their company. So there's a couple of really neat ways on how to really determine and distinguish whether or not a guaranteed income annuity is correct for your situation. One is to see, okay, do I just want to have max income and I don't really care about leaving a death benefit, or I don't really care about controlling my account value and having growth and stepping up in income later on? Because if that's the case, then you want to go into some sort of annuitization product. My whole mindset behind it, because I've seen a lot of different scenarios and we get bombarded with calls every single day, are people start to gravitate a little bit more towards the hybrid, where dependent upon their age, dependent upon their specific situation, they could leverage their exact retirement goal or retirement income goal and set up portions of different hybrid annuity contracts or just different types of safe money contracts, making sure that they're accomplishing that goal every step of the way. One of the other things that I really want you guys to understand is, and what I mentioned before was the smoke and mirrors effect. Now, in a perfect scenario, let's say if we have an individual that's age 60 and they go and they purchase a $100,000 hybrid annuity and they're looking to turn on income at age 70. So we understand that's going to be a 10-year deferral, right? The way that a hybrid annuity works is this $100,000, when the individual purchases their contract, they're going to see two separate statements. One that's going to read their account value side, and then one that's going to read their income base side. Okay? Account value is your actual physical money. That's the physical $100,000 that, because it's a hybrid annuity, it's going to receive credit gains whenever the market goes up, receive a gain of 0% whenever the market goes down, receive a credit gain whenever the market goes up, whenever the index that they choose goes up, receive 0% whenever the market goes down, or whenever the index they choose goes down. So you always have that peace of mind of that 0% floor at all times. Now, this bucket is always going to increase anytime that there's an upward market movement, because it's essentially like a bucket with a lid over it. After every year, they're going to say, okay, if there's a gain, we're going to open up this lid, pour the gain inside, close the lid again. And now you have a larger bucket than you did the previous year. This is your control aspect. This is your physical money. This is what you're going to leave to your beneficiaries at a later date. Now, this income base is something through an income rider. So when you're looking at this income base and income rider and trying to determine whether or not a company is giving you a favorable contract or not, depends upon two major factors. First off, is this income base, does it have a specific compound roll-up guarantee that you could say, okay, at exactly age 70, with a worst case scenario, the company is going to give you a specific dollar amount in this income base. So maybe based upon this individual situation, this account is going to, their account value is guaranteed to not fall below 0%. So maybe after 10 years, if the market's going to crash every single year for 10 years, they could walk away with $100,000. This is in a worst case scenario, but maybe their income base is now sitting at $300,000. So that income roll up, there's certain criteria that companies give a contractual guarantee based upon that income base and based upon that income roll up. Now, the income base is not the only thing to consider regarding these types of contracts, and it's so vital that you understand that. What determines how much lifetime income and essentially what you're looking for, what that equation is it's going to be whatever your income base is multiplied by something known as a withdrawal rate percentage, and that's what equals your lifetime income amount. So this withdrawal rate percentage is typically always locked into a specific age limit. So maybe this withdrawal rate percentage at age 70 would be 6% for an individual. But if they wanted to execute their lifetime income rider at age 65, it might be 5.5% for an individual. So with that being said, you have some carriers that make this income base, they make this income base gain so high that you might have company A that has a $500,000 income base at age 70, but a withdrawal rate percentage of 4%, as opposed to that other product line that has a $300,000 income base percentage at 7%. So we understand, in order to calculate your lifetime income, even though your income base is higher with company A than it is than company B, company A is only giving you your income base multiplied by your withdrawal rate percentage would only equate to $20,000, as opposed to company B that your income base multiplied by your withdrawal rate percentage of 7% is $21,000. So that's where you could, and you would want to go with company B as opposed to company A. So it's not just, okay, what is the guarantee on that roll-up side, and then just say, oh, because that looks very high, let me just, execute that lifetime income amount. Because you have a lot of companies out there that they try to make sure that this number is so high, but their withdrawal rate percentage is so low. So you have to find a happy medium. And that's one of the things that we try to really specialize in with somebody that's interested in a guaranteed annuity or guaranteed income annuity. We try to make sure that you're matched up to the decimal point, that you're utilizing the smallest amount of dollars possible. And if you're interested in these types of contracts, depending upon your area, depending upon the dollar amount, depending upon your income goal, we could determine, we have proprietary strategies and software, and we leverage all the different carriers in your particular area to make sure that we're producing that optimal result. So with that individual has $500,000, maybe it's only going to cost $150,000 to accomplish that $10,000 goal. But they don't have to leverage the full $500,000 and place it within one of these annuity contracts. The most important thing to really get out of this entire video is that annuities serve their purpose, but you do not want to place all of your money within annuities. If you can, you want to make sure that you have the most control possible. You want to make sure that you have the most leverage possible at your fingertips. And this is the different things that we try to show you. We try to educate you. If you're interested at all in a guaranteed income annuity and possibly seeing how to accomplish your retirement income goal successfully by possibly utilizing one of these product lines or just some other sort of safe money contract, please give the 1-800 number a call. It's 1-800-566-1002. What you're going to be doing is dealing with a specialist. You could be myself, it could be one of my other advisors, and we're going to ask you a slew of questions. We're going to have your brain think on, what is my goal? Is this exactly what I want to accomplish? Can I accomplish this without leveraging an annuity contract? And there's many times that an individual can without utilizing an annuity or some other sort of financial contract, and what they're doing is going to work out properly. It'll get them from point A to point B successfully. But then there are those other times that there's gaps within that plan. There's people that are very uncertain on how to accomplish their retirement goals successfully. And that's where we really try to help in. If there's certain gaps and we uncover certain gaps with you, we'll make sure to go through all the different scenarios. So we go through over 300 different carriers depending upon your state, depending upon your area, and then multiple proprietary strategies. On average, whenever an individual calls into our office and we set up a plan for them, we go through over 1,200 different products and scenarios, making sure that we're going to give our most recommended option and most optimal result to accomplish their goals successfully. We are A+ rated on the Better Business Bureau. We've always had very good reviews. We've never had any complaints. And the reason being is because of our systematic process. The name of this process is known as the Retire Sharp Planning System. At any point in time, please feel free to subscribe to our YouTube channel so you have access to the most updated videos. We try to shoot out videos on a weekly basis. And once again, my name is Derek Afasi. I want to thank you very much for watching this video. And we definitely look forward to speaking with you. Give our number a call, 1-800-566-1002. Thanks, guys.